We're diving into some really interesting territory with this deep dive um, real estate investment.
Okay.
Specifically, we're going to unpack cap rates and this whole idea of an EBITDA multiple for properties.
Yeah, it's fascinating. It's a fascinating area where the worlds of real estate and business valuation kind of intersect.
Yeah, and it can get a little jargony, but we're going to try
Mm.
to demystify it all.
Yeah.
Because once you grasp these concepts,
Mm.
you can analyze properties with a whole new level of confidence.
Right.
So let's start with the basics, but we won't spend all day here because I know you follow this stuff, you're familiar with the territory.
Sure.
What exactly is a cap rate, and why should someone interested in real estate care about it?
So think of a cap rate as a quick indicator of a property's potential return on investment, or ROI.
Okay.
It's a snapshot of how effectively a property generates income compared to its market value.
Hmm.
Imagine you're buying a rental property outright, no mortgage. The cap rate gives you a sense of how quickly that rental income could recoup your initial investment.
So if I see a property with a high cap rate, that's automatically a good thing, right? More bang for my buck.
Not necessarily. It's tempting to think that way, but a higher cap rate often signals higher risk, not just higher returns.
Okay.
A property with a 10% cap rate might seem fantastic on paper,
Right.
but what if that high rate is due to extremely high vacancy rates or a history of difficult tenants? Suddenly that 10% doesn't seem so appealing.
That's a great point. It's like seeing a stock with an unusually high dividend yield. It could be a fantastic opportunity or it could be a red flag.
Exactly.
Now, you mentioned that cap rate is like the EBITDA multiple for properties, which brings us to another piece of jargon. For those not steeped in the business world, can you break down what EBITDA is and how it relates to real estate?
Absolutely. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Essentially, it helps you isolate a company's core operating profitability, what it's truly earning from its business activities, before factoring in things like financing costs or accounting measures like depreciation.
Yeah. So it's like stripping away the financial noise and getting to the heart of a company's earning power.
Exactly.
But how does that translate to real estate? We don't have earnings in the traditional sense when it comes to a building or an apartment complex.
Yeah.
Or do we?
You're spot on. That's where NOI, or net operating income, comes into play, and it's inextricably linked to the cap rate.
Okay.
Yeah.
Okay, NOI. Sounds like we're about to unlock a key piece of the real estate puzzle here.
Yeah.
What exactly is net operating income, and how do we calculate it?
Yeah. So NOI, it's essentially the lifeblood of a real estate investment. It represents the income a property generates after deducting those necessary operating expenses, but before factoring in things like mortgage payments, income taxes, or depreciation. It's a pure measure of the property's ability to generate income from its operations.
So if I'm considering buying a rental property, I need to look beyond just the potential rental income and really drill down into those operating expenses. What kind of things fall under that umbrella?
Great question. Operating expenses encompass all the costs associated with running and maintaining the property. This could include property management fees, routine repairs, property taxes, insurance premiums, utilities like water and electricity, and even landscaping costs. It's about keeping the property in good shape and ensuring a positive experience for tenants.
Right, because neglecting those operating expenses might seem like a way to boost your profits in the short term, but it can lead to bigger problems down the line. So we've got cap rate, which is calculated using NOI, and we know that NOI is influenced by those operating expenses. But what other factors influence those all-important cap rates?
Location plays a massive role. As the old adage goes, location, location, location.
Yeah.
Properties in highly desirable areas, think bustling city centers, trendy neighborhoods, or areas known for their excellent schools, typically command lower cap rates.
Because investors are willing to accept a lower potential return for the perceived stability and long-term appreciation potential of those prime locations?
Exactly. They're seen as safer, more predictable investments. On the flip side, properties in less established or desirable areas might have higher cap rates to compensate for the perceived higher risk. That higher potential return is meant to entice investors willing to take on a bit more uncertainty.
So it's a trade-off between risk and potential reward influenced heavily by location. What about the type of property? Does that impact cap rates as well?
Absolutely. Different property types come with their own unique risk profiles and income-generating potentials. For instance, a brand new luxury apartment complex in a desirable urban area might have a lower cap rate than, say, a 1970s-era office building in a suburban office park, even if their NOIs are similar.
Because that luxury apartment complex is perceived as a more resilient investment, less susceptible to economic downturns. People always need a place to live, but demand for office space can fluctuate, especially in today's world.
You've got it. That perceived stability contributes to a lower cap rate. Investors are comfortable accepting a low potential return for the peace of mind that comes with a more stable asset class.
Okay, so we've got this idea of cap rates being like a financial compass for real estate investors. But how do they actually use this compass to navigate the market and make smart investment decisions?
Well, one way is by using cap rates to compare similar properties, especially when deciding where to allocate capital. Imagine you're looking at two apartment buildings in the same neighborhood, both with comparable NOIs. One has a 6% cap rate and the other has an 8% cap rate. At first glance, the 8% property seems like the clear winner, right?
Higher potential return for a similar income stream.
Yeah,
Makes sense.
exactly. But here's where the real analysis comes in. That higher cap rate might be a signal to dig deeper. It could indicate that the property with the 8% cap rate has higher operating expenses, perhaps due to outdated systems that need replacing soon, or maybe it has shorter term leases with tenants creating more uncertainty about future income.
So it's not just about chasing the highest cap rate, but understanding the why behind the number.
Precisely savvy investors use cap rates as a starting point for deeper due diligence, not as the be-all and end-all of their decision-making. They look at factors like the age of the property, the condition of its systems, upcoming renovations, and even the quality of the tenants.
It's about looking beyond the surface and understanding the nuances of each investment opportunity. Now, beyond evaluating individual properties, I'm curious about how cap rates can provide insights into broader market trends. Can you elaborate on that a bit?
Absolutely. Think of cap rates as a gauge of investor sentiment in a particular market or property sector. If you see cap rates compressing, meaning they're trending downward over time, it often signals growing confidence in that market sphere. Investors are willing to accept lower returns because they anticipate future appreciation in property values.
So it's like a self-fulfilling prophecy. Confidence drives prices up, leading to even lower cap rates as investors pile in.
Exactly. Conversely, if cap rates are expanding, meaning they're trending upward, it could be a sign of increasing risk perception in the market. Investors become more cautious, demanding higher returns to compensate for that perceived risk.
So if I see cap rates for office buildings in a particular city starting to rise, it might be a sign that investors are getting nervous about the future of office space in that location.
That's a very astute observation. It could reflect concerns about factors like remote work trends, oversupply of office space, or even economic headwinds specific to that city.
It's like having an extra layer of insight into the collective thinking of the market. Now, before we wrap up this deep dive, I wanted to circle back to Michael Linton, the commercial real estate expert whose work we've been referencing.
Right. Michael's insights on his website, chicagodealflow.com, have been incredibly valuable in understanding how these concepts play out in the real world, especially in a market like Chicago. He's a big proponent of investors truly understanding cap rates, NOI, and how this idea of an EBITDA multiple applies to real estate.
It's about empowering yourself with the knowledge to make informed decisions, whether you're a seasoned investor or just starting to explore the world of real estate. So as we wrap things up, what's the most important takeaway you want our listener to remember about cap rates?
I think the most important thing to remember is that cap rates are a powerful tool, but they're just one piece of the puzzle. Don't be seduced by a high cap rate or turned off by a low one without digging deeper into the underlying story that those numbers are telling you.
It's about connecting the dots between those financial metrics and the real-world dynamics of the real estate market. Well said. That's all the time we have for this deep dive. Until next time, keep exploring, keep learning, and keep diving deep into the topics that matter to you.